All right, well, the International Monetary Fund issuing a gloomy global outlook for 2023, warning of slower growth and the risk of recession next year. Yahoo Finance's Schonberger sat down with the fund's Director of Monetary Policy and Capital Markets. Jen, what did they tell you?
Hey, good afternoon, Rochelle. That's right. The IMF downgrading its outlook for global growth and also warning that the risks to the stability of the global financial system have, quote, materially worsened and that markets are at risk of disorderly repricing. As you mentioned, I sat down with Tobias, Adrian, the head of capital markets and monetary policy for the IMF, to discuss this and whether some of the turmoil that we've seen in Britain's bond market could be a precursor for elsewhere. Take a listen.
We have certainly seen market illiquidity in many markets around the world, but market dysfunction we have only seen in the UK in recent weeks. So what's happening there is that a new fiscal plan was announced, and that has led to a very, very sharp rise in interest rates. And the rise in interest rates has been dysfunctional with adverse feedback loops due to financial vulnerabilities in the non-bank financial sector. So that's what triggered the Bank of England to intervene in order to restore orderly market functioning. And while the rise in interest rates has co-moved to some degree with other interest rates, that's something very normal. Interest rates tend to move together. We haven't seen a spillover in terms of market dysfunction.
So you're not seeing any similar risks akin to what we're seeing playing out in the UK now that may be brewing in other markets around the world, to be clear?
Well, there's certainly risks that the situation could change. So what we've seen around the world in many countries is that interest rates have been increased tremendously. In some countries, 3, 4, 5%. In other countries, even more than that. Most of that tightening has been done within orderly market conditions. So it has been an orderly tightening. And our baseline forecast is that this orderly tightening is going to continue. Having said that, there is certainly a risk of disorderly tightening at some point. There could be dysfunction more broadly outside of the UK as well.
So Warren Buffett famously has said that when the tide runs out, we find out who has been skinny dipping. So as central banks around the world have been raising rates, what sorts of vulnerabilities has that revealed? Is this perhaps the point in time where China's property market finally sees a potential for reckoning after experts have been calling for this for 15 years now? Does the US housing market have farther to drop? What are some unforeseen vulnerabilities there that this is unmasking?
So there are many vulnerabilities out there, and we're flagging in the Global Financial Stability Report what kind of vulnerabilities could be acting up once negative shocks are hitting. So we see leverage, we see maturity transformation and liquidity mismatches around the world, particularly in the non-bank financial sector. And when further negative news was to occur for a variety of reasons, that could indeed uncover those vulnerabilities.
Switching gears slightly, in the report, you notate the IMF's global bank stress test shows that in a scenario with an abrupt and sharp tightening of financial conditions, that would send the global economy into recession in 2023 amid high inflation. My question is, how close are we to that sort of scenario, given that financial conditions have already tightened quite a bit? Would it be prudent for central banks and the Fed to perhaps hit the pause button here and take a step back, given that monetary policy operates with a lag, and see how things progress before hiking further?
Yeah, we are very comfortable with the monetary policy that is currently envisioned by the Federal Reserve and that is priced into markets. We think that this is what is needed in order to get inflation down. So to get inflation down, you need to slow economic activity to some degree. Hopefully, this will be a soft landing or even if it was to be a recession, it could be a shallow recession, we hope. But of course, there are downside risks around that forecast, and we could see a more severe recession with a relatively high likelihood.
Well, there you have it. The IMF appears to be on the same page as the Federal Reserve when it comes to rate hikes and fighting inflation. Of course, whether that means a soft landing or a shallow recession remains to be seen, guys.